Welcome back, everybody, to We Are TPM with myself, Kyle Teixeira, sitting next to, once again, John Teixeira. We are back this week to interview and discuss investing and everything real estate with Pete Montesino. Thank you for coming in, Pete. We appreciate having you on today.
Yeah, great. Thanks for having me, guys.
We're not going to do show me the
Definitely.
money.
If you guys have any... He wants to interrupt my intro already. I'm just kidding. If you guys have any questions on this podcast, want to talk to us, want to talk to Pete, or any questions you may have, give us a call, 817-818-9039. Shoot us an email at showmethemoney@wearetpm.com. Now let's get into it. Thanks for coming on, Pete.
Yeah, hey, thanks, guys.
It's as you can see, Kyle and I are repping Rangers today because it's opening day. We're really excited. So I don't know when you're going to be hearing this. You're not going to be hearing this for a couple weeks. Hopefully the Rangers are like 10-3 by the time you hear this. But today, as of recording, we're opening day. We're excited, and so that's why we're repping the Rangers today. But having said that, thanks for coming, Pete. Pete and I have, in a short period of time, gotten to know each other a little bit and become friends. And Pete, I really wanted to bring you on to see if you could, I thought you might be somebody that could help share with our audience some experiences, whether they're your own or people you've helped and known in the past, of people that have built wealth with real estate. Because one of the things we want to do, Kyle and I want to do here, is not just teach people how to do it and give specifics, but we really want to inspire also with some stories. And we're hoping that maybe you can bring some of those stories to us today.
Cool. Yeah.
Love it.
Well, shoot, I guess the best part to talk about kind of how I got into the business real quick, or not in the business, but, bought my first house, but started in the industry. I had no direction whatsoever. I was just a young kid having fun, going through high school, college, and happened to stumble across the mortgage business when I was like 20 years old or 21.
Wow.
And anyway, that was my first experience. I really had no direction on, what I should have been doing or what I could have been doing until years in. But, it was a cool experience learning. And then, going through some of this stuff myself, I've got a couple of stories, and I guess I could start with myself, with regards to real estate and how I've done. I was probably 26, I think, when I bought my first house. I wish someone would have told me at 22 to go ahead and do it because, it's a long game, right? Most of the time you're not buying to get rich in a year on one house, but if you can hang on to that house, convert that house into a rental and then hang on to it for years, you're going to build wealth that way with that property. And so anyway, I started at 26. And I had that house for 19 years. I bought it for 215 grand. Sold for 594 grand.
Love it.
19 years later.
Love it.
I'm an old soul, just stick in one place for a long time. But the thing is, it was just natural appreciation of just owning a home. And it was building wealth I otherwise wouldn't have probably been able to do, just having a job. I mean, you get raises yearly, but it kind of takes a while to amass that amount of income or equity. So if you try and save it on your own, it's going to take a while.
So Pete, that plays into something I say on this podcast, and I tell my clients all the time, is the best way to start building wealth with real estate is by owning the home you live in, right? Mm-hmm. And that's what you're telling me you did, and that was kind of the beginning for you. I think that should be the beginning for everybody. Unless you're listening to Grant Cardone, who's telling everybody exactly the opposite for some reason.
And I've read that lately. They say rent or do these different things, I believe a lot of it's directed. If you think you're going to make money in a year, I'm going to buy a house, sell it in a year. You're just not. It's a long game, right?
Yep, it is.
So now to kind of transition to the business, being in the mortgage industry, I started really preaching building wealth in real estate myself with my clients, and the younger I can get a hold of someone, the better. And I had a particular client, and he's become a friend now over the last 15 years, but I remember him coming into my office at mid-20s, and he's like, Pete, I'm going to buy a house. And it was a $70,000 house. Still got this house today after 15 years, and that was his first one. He even had to have his grandfather help him pre-qualify for it. But we got him into the house. He has since kept that house. It's tripled in value. He's made it a rental. And every house we use as a stepping stone. So, if you were to just go out and buy a home, like I want to buy a rental property, it's a bigger down payment. But if you can buy it as your owner occupied house, right? You make that first house a rental. You buy it, make it a rental. In a year, however long before you want to make it a rental, and then we buy the next one with a small down payment. Heck, we can even use down payment assistance to get you into the next house. And we keep doing that every year or so. We keep acquiring the next house.
The
So it
Robert
doesn't take
the Robert Kiyosaki
insane
method.
amounts of money
Yeah.
to be able to get into the next home.
Right.
And before you know it, you hang on to these things and you put them with a property manager, which, coincidentally you guys do. And you hang on to these properties as long as you can. And with time, then you turn them over or do whatever. So kind of that rinse and repeat. And it's just a long game, right? You play long ball versus trying to make fast money.
Well, I have questions, but I'm trying to give Kyle a chance to. You and I can sit and talk forever, right, Pete? We've done that before.
Sure.
No,
Yeah.
I love the baseball reference. You just threw in there. We're playing the long game because you mentioned something about getting into it early, and that's ironically what our listeners know. I preach that. We've been preaching that since we started discussing this because I bought my first property at 20 years old. It was a little biased because my father was in real estate, right? But the knowledge of the investing part of it and how it can be a long game, once you know that, and the earlier you know that, the earlier you can start to harness it, right? Because it compounds and the exponential growth of appreciation in real estate over time can be tapped into just by tapping into it early. So we call it planting the seed of the tree as soon as you can to have the bigger tree, because a lot of my wealth, I'm 29 now, I'm still in my 20s. I attribute most of it to real estate acquisitions. There's other, multiple sources of income and all those things. But when you talk about building wealth, you're talking about stacking assets and stacking equity, right? So the best way I've done that to date, even with multiple streams, is through real estate, because that's the way to hold it, right? We can generate income through operations and businesses all day long, but if you spend it, then you're not generating wealth, you're generating income and expenses. So it's a great way to store value, is the simplest way to put it.
Hopefully this makes some sense here, but especially if you can catch someone young, and even as we get older, we get shiny balls, right? Get the new car, the new whatever, the next best thing, right? And we're wasting money on that stuff. And I think it does translate to the same mindset. You have to live somewhere, right? You start off in a small apartment and then you make more money and you move to a nicer one, or maybe you go on and then you rent a house. But what are you doing? Whose wealth are you contributing to? Right? You're contributing your wealth or somebody else's.
Yeah.
Right? So, the mindset when I go through with my clients and friends, when I even talk to them, is it's like, okay, do you want to rent and pay someone else's mortgage, or do you want to have your own and build equity yourself? Right? There's a lot of advantages to owning a home. And, I was watching this other podcast, and I can't remember who it was, but it was this young girl, and she was talking about this younger Gen, what are we in, Gen Z or whatever it is. They get caught up in buying the next best thing, an iPhone. Like, let me get a new iPhone every year. It's $1,000 a pop, right? She goes, well, I don't do that. She goes, I keep what I have, and instead of buying the next best thing, I take it and invest it into that company's stock. So instead of buying a new iPhone, I take $1,000 and put it in Apple stock or whatever. So, while you've got a depreciating asset, I have an appreciating asset, right? And I look at renting from that perspective. If you can get to where you just start buying right in the very beginning, in the early stages, now you become the company, right? You start generating that wealth and building generational wealth that you may or may not be able to do through your just regular employment. So
I love it.
Yeah, and it's good. It's a good thing to talk about, especially with you being in the lending industry. Is what a lot of people don't talk about, like what Grant Cardone doesn't mention when he tells you not to that buying a house isn't the way, and that it is access, is financial access. Nobody really talks about that factor, but it's a huge factor. Buying your own house is buying a piece of collateral, right? And the products available to purchase a primary residence are significantly different than the products available to buy an investment property. There are advantages to primary residence loans. There are laws that allow you to take money out of primary residences where in some cases you wouldn't be able to take out of investment property. So it can be a key part to your investment journey if you are trying to build a rental portfolio from, just a standard paycheck. So that's the biggest piece to me that people love to not talk about. Grant Cardone doesn't have to follow the FHA laws and and play these lender gymnastics that the normal person has to play. He walks to the bank and gets uncollateralized loans just off reputation, right? So you can't do that. You have to either build up collateral, and you do this BRRRR method. Say you have now a primary residence in 4 houses. Lenders look at that as that's your reputation. You have collateral and you have success in doing this, which gets you better rates and gets you access to loans. Because once you start building a big enough portfolio, as I'm sure you can agree, Pete, it all becomes about reputation, right? If you get over that 10 property mark, the loans you have to go get, they want to show that you've had success doing the business model that you're presenting to them.
Right.
So,
Pete, we talk a lot about the BRRRR method. I'm wondering if you've actually have experience. I'm sure you have lenders or at least clients have done it. If you haven't done it yourself, of using the method where we buy rehab. Usually we're buying with private or hard money a lot of times, right? Buy rehab, refinance into a more conventional loan, or I'm sorry, rent it, then refinance it into a more conventional loan, and then repeat. And that's what we mean by BRRRR. Mm-hmm. How have you done that yourself, or have you helped anybody do that?
So I have, and it's, market conditions kind of dictate how well that, right now it's a weird market because we're coming out of COVID but under a normal market, you buy, renovate, and then rent or resell. So I've been doing that. I've done it several, different ways. We've bought some at auction. That's an experience in itself. We've bought some just through standard, homes for sale on MLS, and then we bought some that were just, we found out people that were wanting to sell, just direct through our sphere. So we have had a lot of success. That is a different. You need to be experienced. When you do that, if you go in, you need to be experienced. You need to have good contractors. You need to have a plan and a budget, right? Because what I've learned, the good and the bad. I mean, the good was, we flipped some for less, and we flipped some for more than what we expected.
Yeah.
And the good thing is to really figure out your budget and try and stay on track and hire good contractors. Cheapest isn't always best. So
that is definitely true.
Pete, what have you used for inspiration? Like we mentioned a couple big names, and Kiyosaki and that other guy. Do you have anybody personally, whether it's a big name author or somebody personally in your life that inspired you and taught you about what you know about wealth building with real estate, other than what you've learned on your own, obviously? But there's always a seed somewhere that somebody.
Well, so I've been with my particular company since 2010, and I've got deep relationships, and we meet together a lot, and we have a lot of successful people in this company that we feed off each other. Yes, I can listen to, you can pick any voice or any
those big name talking heads that are making a name for themselves. Yeah.
So you can pick any of those people, and you get something from all of them, and some good, some bad information, but the most valuable is probably what I've done just internally with our group here. And I like to watch videos and read or listen to audible books and things like that. But ultimately, I believe every market's a little different, and I believe that you can thrive in one place and not in another. So I focus heavily on the market that I'm in this area, and I just talk to people that are doing what I want to do, right? If you have someone that's successful, then follow their recipe, or at least talk to them about it and see how you can, adapt that to something that you can do on your own. I'd mentioned that guy that 15 years ago, and he's become a friend. And the guy's now owned 10 plus houses.
Wow.
He's bought and sold stuff, and he's a millionaire
Wow.
at 40 years old.
I
And he
love
was a
it.
guy that his business was fences, just him and another guy, fences and mowing the yards. That's how he started. And now he's a roofer and he's a realtor. Um, but his main goal in life is to build wealth. He wants to live off of his rentals. He's got VRBOs out in Broken Bow. He's got places locally. He had a garage in Frisco. It's one of those car garages you build up, and anyway, he did all that. And I watched that, and you follow the lead with people that are experts in the market, and they understand when to pivot, when to shift, so you just have to talk to people. And that's I take more local resources than
I,
everything I
I
see
love
online.
that, Kyle. That's what. Go ahead.
No, I love that too. It's ironically the answer I generally give is I've never been inspired by the big names, talking heads. I like to say I've been inspired by the randos that show up on a single on the golf course, or people I've met at conferences that tell me their real life story. That no, I'm in my 40s living off my rental portfolio, and I'm not living like I'm living lavishly off my rental portfolio, So it's not it's everywhere. Like I've met people who have done this constantly, and that's really what's inspired me. Is it's not just some pipe dream. It's not just some fairy tale you see on TikTok. Like this is an actual way to
Well,
generate
let,
passive income.
let's take that angle real quick, Pete, if you don't mind us shifting a little bit this discussion because I think it's going in a great place. I love it, and might be something that people need to. This might be a little mindset shift that people need to. One of the reasons why Pete's even here with us is because of exactly what we're talking about, right? Pete's ability to get out there, put himself out there, regardless of it's a tough market right now. Wouldn't you call it a tough market, Pete?
Oh yeah.
People in your industry are probably shrinking back, doing more, keeping to themselves, not wanting to be just another there's a million roofers and a million lenders out there right now, and they're all hungry, right? They're all starving, except for the guys like you that know you've been in the business a long time, you know what it takes. Continuously do the thing that you need to do, right? Just keep doing the thing. And one of the things I liked about you, Pete, is that you're still out there, you're still doing it, you're networking, you're spending money on your business in the right place. Like you're not putting billboards, or maybe you are, but I don't know of you putting billboards or advertisements out there, but you spent your money building some relationships, which is how I met you, right? And that's also how to the point that Kyle's making, that's also how you start to learn other people's stories. You start to be inspired by what they're doing, to give yourself, to surround yourself with the right people to inspire yourself to go and take some action and do the thing that you know needs to be done to build wealth for your family. What do you think about that, Pete?
No, 100%, 100%. I don't buy billboards, by the way. I don't buy leads. It is 100% relationship. And relationships take time. With anything you do, right? If it's a new job, it takes time. If it's a new, you meet a new girlfriend, boyfriend, whatever, it takes time to develop relationships. Um, so I believe in our industry, it does take time, but it's an investment. I also feel like every client I work with personally, I invest in them. I invest time, not just with my realtor partners or my builders or whoever. It's with my actual clients. We try and go deep. How you got to figure out the goal, and the mindset shift for a lot of people. They just really think that it's super expensive to buy a house. To give you an example, I have a guy that's so excited. He's going to close in about a week. He has to bring $1,000 to closing on a 21,000 dollar house. $1,000.
Wow,
And
that's
that
crazy.
includes earnest money. I mean,
That's
that is
point.
like that's in there. That's less, the earnest money's net of about $1,000 after earnest money.
That's
So,
0.3%,
um,
right?
you would think that it's not expensive, and that's the mindset shift that we have to help most people understand is okay, rates aren't going back down to 3%. All right, let's just go ahead and say it. It's not.
Right.
Unless if it does, it means something really bad happened in our world.
That's right.
And I don't know that I want COVID again.
That's right.
So at least, that 2 years of pain that we experienced. Um, so the rates are what they're going to be, but prices are good. It's an opportunity to grow, and once you can help them shift that mindset just a little bit to understand you got to live somewhere. You're going to spend money somewhere. Tell you what, it's probably easier to, if you got in a real pinch, to sell a house than it is to or rent it, to sell or rent a house than it is to get out of a lease on an apartment. Have you ever tried to get out of a lease on an apartment? I
Yeah.
mean, you're stuck in that thing. If you ever try and break that, but at least a house, if you really got in a bind, you could rent it and go live, do whatever you have to do. But
And guess what? You're still building wealth for yourself.
What's that?
And you're still building wealth for yourself while you're renting
You're building
it.
wealth for yourself. We hadn't even gotten in, and I'm not an accountant or a CPA. I'm not going to claim to be, but there are tax advantages to owning a house. You
Yeah.
have the opportunity to write off taxes. You have the opportunity to write off interest. There are opportunities to owning a home that you do not have if you do not own a home. Um, the reason why I don't listen to the talking heads is the fun thing about the talking heads in the world is that one day they'll be over here and the next day they'll be over here. It's like
Yeah.
it's just constantly changing. There's a few that have kind of stayed the course. I think Dave Ramsey's one of them. He's like,
Dave
he's
Ramsey.
always been Dave Ramsey,
Mm-hmm.
right? But the other guys, they kind of swing back and forth like a pendulum, depending on, what the market's doing on any particular day. That's to get clicks, probably, right?
Yeah.
But in the real world, the people that are becoming wealthy are the people that own real estate. It's a hedge against, so almost recession proof. Even when we went through in 2000, what, 7, 8, 9, 10, that first house I told you that I had, I didn't lose value. It just didn't go up anymore for a few years, right? While we went through that. But then it went up exponentially over the next 10 or 12. So
Well,
it's just
and
a hedge against recession.
and truthfully, the value of that house didn't matter during that time unless you realized it by selling it, right? You're
Exactly.
either going to realize
I
a
wanted the
gain
house to
or
be
a
worth
loss.
0 at the time.
Right.
For property taxes.
I
But
love
yeah,
it.
exactly.
Well, and
So it didn't matter. I wasn't moving.
you never know for sure, what timing the real estate market is a really hard thing to do because you're playing the long game, right? But you said that first house you sold for a huge profit you had for 16 years. I've seen people make that in 3 and make that in 30. So it just depends on, it's not necessarily when you get in, it's the fact that you get in, is
You
a
need to
huge
get
part
it.
of it.
I mean, how many houses and I don't care if you own a house or not. You can go anywhere, and if we're in the Metroplex, right? You had bought a house 10 years ago. I guarantee it's worth more today than it was 10 years ago.
We ca-
So doesn't matter what the market did. We're gonna have ups and downs. It's an investment that now at the end of your investment, or whenever you choose to sell it, you should, if you've lived there for a period of time, you should have equity in that house. You have something to take with you. So
Kyle alluded to this. We call that planting the tree of wealth, right? So every
Right.
house is a separate tree of wealth, and the idea is to hopefully you have a grove instead of just a tree, right? Hopefully you have multiple trees that are all building wealth for yourself, and even if it's not just houses and it's businesses or whatever that is for you, it's important to continue expanding that quote unquote empire.
one thing we hadn't talked about that's just real quick is the sense of community, right? I mean, there's a sense of community once you
Mm-hmm.
have your own place. You get to pick, I want to live in this neighborhood.
Mm.
I want to go to my kids to go to this school. You know, you can develop roots there. And
Mm-hmm.
you know, it's very transient in apartment complexes and things like that. People are in and out all the time.
Mm-hmm.
And, usually if once you can develop roots, I mean, I think your happiness goes up. Life gets, there's an improvement in your life.
Mm-hmm.
Most of the time, I can't say every time, but you don't get that if you're renting an apartment or, you hadn't developed those roots yet, in my opinion.
Love it.
Well, yeah, that's you alluded to one of the negatives earlier about if something goes bad, you just rent it out, right? That's your worst case. I mean, that nobody likes to compare that to renting, but we are property managers, and I can assure you that property managers when things go bad, property managers move a lot quicker than foreclosure lawyers do. Um, so that is a worst case scenario and should be considered that, you still own that home and can rent it and turn that negative into a positive, which we have seen a lot of clients do when things do go bad. Where in renting, like you said, you're breaking a lease, the fees for breaking a lease are high. The effects of evictions are lasting and significant to your ability to re-rent and
Well,
purchase.
I'll tell you this because I pull credits quite often, right? I see more collections or charge-offs or judgments for apartment complexes on credit reports than I ever see foreclosures. Um,
Oh yeah.
because you can't get out of an apartment, so that's why, again, a lot of people fear, like, I don't want to be the landlord, but they got guys like I mean, you guys take the stress out of it, right? I mean, you just run it, and if they lose a tenant, you replace the tenant, and
That's right.
it's a fairly seamless process. It may have some delay or some drag there from time to time, but you know, that was always my fear of being being the landlord, is what happens if they leave? How do I manage it? But you realize it's really not that big a deal most of the time. You run into instances, but you know, when you have someone that can take care of it for you, it's unbelievable. So, you would ask me about my portfolio of houses. And, the intent was when we got into the business that it was going to be easy money, right? The Burr method. And it
Hmm.
just didn't quite work out. We wanted to flip them, but we couldn't. So we rented them. And every rental, although we couldn't sell it for what we wanted to sell it for, we were able to rent it for what we wanted to rent it for. And it was not a problem at all. So.
Hmm.
Well, it's good. And Pete, I want to ask you, in building your portfolio, you've already expressed your understanding that the market shifts happen and over time, and they happen often. Well, we talk a lot about on this podcast about the different tools or products that are are used in various markets when acquire real estate. And we call it creative financing. So, have you used any creative financing products in your journey?
So, yeah, I'm glad you asked. One of the best ones now, if you want to buy an investment property, the by far the best loan is a DSCR loan right now. If
Yeah.
you're already, you already own a home and you want to buy a rental, you don't want to make your current property a rental, you want to buy a straight up rental. This DSCR loan is by far the best loan. It's no income, no. I mean, we look at credit. We don't even ask where you work. It's 20% down. It is the easiest loan that you will ever get. All they care about is how much will it rent for. And as long as it rents for 80% of whatever the payment is, good to go. Um, Easy.
Well,
It's
and
one
it's
of
You
them.
said you
It's
said 20% down, Pete.
20% for investment property DSCR loan.
Is
And
that
depending on the loans, what's that?
is how many of those can you do, and does it remain 20% as you stack those on top of each other?
So you can do up to with this. Well, you can go to we've got multiple outlets for
Is that a
them. One
Fannie
in
Mae thing?
particular. No, it's not Fannie
Okay.
Mae. These are private money. You go up to $5 million worth of loans.
Yeah.
So, I mean, how many
I
can you
mean,
get?
they are the best. I mean,
So,
and
there's a bunch there with one investor, right? Then you just shift to the other one if you
Yeah.
wanted to. But it's such a good loan. And the rates, people are like, what are they going to be in the nines? No, depending on the loan size. If it's like a $250,000 loan, rates are in the upper or the mid to low sevens. If you start getting bigger, three or $400,000, and you might see the upper sixes on the rates, and they're 30-year fixed rate loans. Super, super good loans
yeah,
for that program.
and people, I've had investors ask me, they're like, "Man, are we looking at an '08 again because DSCR is so hot and they don't even check if you work?" And I'm like, "No, it's a simple product. It stands for debt service coverage ratio.
Right,
It's a loan that makes sure that it can pay for itself. Um,
right.
that's why they don't care about
Ex-
your income, all right?"
Yeah, I mean, in '08, I was in the business and I remember vividly the changes.
Yeah,
Just because we're not verifying income doesn't mean we're not looking at assets and we're looking at credit. Back in '08 and '07,
we
a
weren't talking
heartbeat
about,
got you a loan.
and we weren't talking
And
about
you got 100,
rentals.
yeah, you got 100% financing. Low credit was okay. You didn't have to prove that you were able to pay your bills back. It's completely different. Plus, you got skin in the game on these houses. You got 20% down. So
Yeah,
Yeah,
we're
yeah.
80/20s. We were doing 80/20s and 90/10/10s and all those things all day long, and I think those are all
And it's a big
gone.
product for refinancing, especially recently, because you don't always need the 20%. If you have the 20% equity, you can refinance this without having it tied to your personals.
So you had asked about programs. So one another trick up the sleeve for with rates being a little higher for owner occupied houses is we do what's called a temporary buy downs. So you probably heard of those. But in the past we would do a permanent buy down, right? Lenders would say, all right, Mr. or Mrs. Buyer, pay a point, which is 1% of the loan amount, and we'd lower your rate by 1/4%. So if the rate was 6, it would go to 5.75. And that's great, right? If you pay 2 points, maybe it's 5.5. But then that's it. The money is spent. So that's a permanent buy down. On a temporary buy down, what we're doing for our buyers that are occupying. So if your rate's at 6%, let's say we get the seller to pay some closing costs, because right now it's pretty common the sellers are paying some closing costs. If we can get the seller to pay, I want to say it's like 7 or 8 grand towards closing costs, instead of starting your rate at or your loan at 6% for the first year, we'll start at 4%. We'll drop it 2 full% in interest rate, not just a quarter. Now, you want to talk about a big swing in payment on your $350,000 house. That's about a $400 or $500 a month swing in payment. So the first year is at 4%. The reason why they call it a 2-1 buy down is the first year is 2% below, the second year is 1% below. So then would go to 5%. And if you still have that loan on the third year, then it would get to 6%. So the reason why it's called a temporary buy down as well is what I like is unlike the permanent buy down, the temporary, that money that you buy the rate down with sits in a separate, subsidized account, right, for the homeowner. And let's say in a year rates come down and they want to refinance it. You can do that. What's cool is whatever's left in this account will be credited towards your payoff. You never lose those funds. They're not spent. Like if you had done a permanent buy down, once that,
It's more like a
points the
fee.
seller gave you to buy down the rate, that's gone. It's if you refinance in a year, it's 60 months or so to break even.
It's more like a fee, where this buy down is more like goes toward your principal
Okay, it's like
if it's
100%.
unused.
So it's a really cool loan that helps at least ease into the payment. And most people realize once they get in the house, like, oh, I could make this payment. It wasn't as scary as I thought it would be. But at least it starts them off lower, and they got this first year, second year, and then, if it's there in the third year. So
Interesting.
it's pretty cool loan.
Any other products? That's all conventional. It sounds like.
We've got bank statement loans.
Yeah.
12-month personal, 12-month business. For those that don't show income, you're self-employed and you make plenty of money, but you don't pay taxes on it. Call what it is. All goes into your business account. We can use those business statements for 12 months. You just have to have had your business established for 2 years.
Yeah.
So as long as you have a business and you've at least had it incorporated, or we can verify that it's existed for 24 months, then we can use 12 months bank statements. So, and the rates on those are in the 7s or upper 6s as well, depending on the loan size. What's funny is loans, the rates, people ask me, what are the rates today? I'm like, well, what's the loan size? Because the loan size dictates more of what the rate will be and your credit score than anything else. We're doing some loans with alternate income sources like bank statements that have better interest rates than the Fannie Mae loans, the full docs. It's just, these are private equity companies that basically give
Underwriting
this money for buyers. So if you got better credit, bigger loan, you get a better rate.
Pete, if people have questions about the types of loans that you've brought up and want to get a hold of you, how would they do that?
You can call me on my cell phone.
Shoot it.
Want me to give you that?
Shoot it to us. Yeah, do it.
And type it on the board there. I should put it back there on the sign. Show me the money.
Andrew will put it up on the.
You want me to just tell you? It's 214-649-4908.
Very good. That's the best way to reach you then?
Yeah, I love it. Calls are great. You can always email me, but I'm a guy that likes to talk to people. I'm not going to hide behind texting and emailing. I will talk on the phone. So
Pete, thanks for coming on and sharing. You've been really insightful and hopefully helpful to our little audience here, and we appreciate you very much.
Yeah,
Go
I
Rangers.
appreciate the opportunity, guys.
Really appreciate you coming on. This is exactly what, like we said, this is exactly what inspires people to do what you did. So really do appreciate it.
Thanks, guys.
If you guys have any questions about anything we've talked about today, want to get connected with Pete, didn't catch that number or anything else, give us a call, 817-818-9039, or shoot us an email at showmethemoney@wearetpm.com. We appreciate you guys, and we are out to opening day.